So when it comes to a whole life insurance policy, which product should you choose? Because there are a lot of options that are available. Well, in today's video, we are going to cover traditional whole life insurance policies, which are actually the most commonly sold whole life insurance products. If you were to look at life insurance carriers across the board, especially the major mutual companies, which are the companies I study the most, the primary products sold are their traditional whole life insurance policies. So what that means, when I keep on saying traditional life insurance policies, is often you'll see in the name, for example, Mass Mutual has what is called a Whole Life 100 policy. What that means is that premiums are payable up until your age of 100. Guardian, on the other hand, has a number of traditional policies. One example is an L99, life paid up at 99. What that means is that premium payments are due up until, you guessed it, the age of 99. 121 means that premiums are due or payable up until the age of 121. Now, you might be thinking, who on earth wants to pay premiums that long? Until I'm 100? Like, I'm not even going to make it that long. A lot of times people express that to us. I remember one of my friends said, I'm going to be dead by that point in time. I don't want to have to make payments that long. And I say that because this is often what races through individuals' minds. It raced through my mind. If you're not in the business, that's the case. So, with that said, do you have to make payments forever up until the age of 100? The answer is no, not at all. We have a ton of people we work with that will take out a Whole Life 100 policy and have the intention to pay into it, perhaps only for 5 years. But why they go with a Whole Life 100 policy is they want the option to continue to make payments beyond 5 years. So a benefit to traditional policies, to any type of traditional whole life insurance policy, is if you said, I'm uncertain on how long I want to make payments, or I want the ability to pay money into this policy as long as possible, that's where a traditional whole life insurance policy definitely has an advantage because you can keep on pumping money in. What we're going to look at in examples, what we're going to look at in different examples, I should say, is what a policy looks like if you pay into it only for 5 years, then for 25 years. What if I keep on paying? It's good to see that up front so you can get a flavor of what these different policies and designs look like. Now, here's the technical details that are important to be aware of. If I were to look at these two types of policies, the Whole Life 100, we're going to look at this specifically with Mass Mutual, and then the L99 with Guardian. When you're going to pay any amount of money into a whole life insurance policy, you can actually choose where that money goes. Often people think, hey, if I'm buying a whole life insurance policy, I buy a death benefit and eventually this cash value builds up. Whereas people who are interested in the cash value can choose how much of that dollar goes toward premium and how much goes toward that PUA rider, which stands for paid up additions, accelerate the cash value. I could snap my fingers today. So, premium. Dollars that go toward the premium piece with a traditional policy like a Whole Life 100, you will see this. 0 or a very, very small percentage of that premium payment shows up in cash value during the first and second year. The reason why is how a traditional whole life insurance product works is that the life insurance company is going to overcharge you for the whole life death benefit right off the bat. Beginning the third year, you'll see whatever your premium payment is does come back to cash value. That's money that begins to earn dividends, begins to compound. You have access to that cash value, so you start to see some buildup. However, the first and second year, nothing shows up in cash value. This is why if you're ever sold on a basic whole life insurance policy, you're looking at the numbers and thinking, this thing takes me more than 10 years just to get my money back. Why on earth would I do that? That's usually a case where I have 100% of the payment directed toward premium, and it's often a traditional whole life insurance policy as well. So the main drawback, like why would I not do this? Why would I not go with a traditional whole life insurance policy? The area that inflicts pain with so many people is right here, the first and second year. The PUA rider, on the other hand, and this is fairly consistent with all products and companies. There's some differences with limited pay products, but what you'll see, that shows up in cash value minus the PUA rider fee. So if I pay 10 grand in here, I'll see anywhere between 9,000 and 9,500 right off the bat. So the majority shows up in cash value. I can access it, begins to earn the guaranteed rate, really the key to accelerating the cash value on any life insurance policy. Main takeaway though is what? The base premium dollars with a traditional whole life insurance policy do not show up in cash value right off the bat. A traditional whole life insurance policy is a fantastic option if you A, want to make payments for a long period of time, or B, you're uncertain how long you want to pay in, but you want the option to keep on going. So let's look at some examples. First, we'll touch on the design, and then we'll do some customization. So specifically, when I say touch on the design, here is a traditional old school whole life insurance policy. What we've got here is just $10,000 directed straight to premium. So anytime I look at one of these ledgers, a life insurance illustration, my question, if I'm you, if I'm the consumer, is where is my money going and what's the product type? Product type, whole life 100, traditional whole life insurance policy. Here we go. This is just a straightforward base premium policy. We've got $10,000 going in. Where we see base policy insurance, that's your base premium. So going back to the whiteboard, money can go where? Premium or toward the PUA rider. Dollars that go toward the premium with respect to your cash value right off the bat. What do we see in the first year? 0. The reason why, so of this annual outlay, 100% of the payment is directed toward the premium piece, which means I get a death benefit right off the bat, but nothing in cash value. Beginning the second year, I pay $10,000. I get a little bit of a dividend, $11.85. And when I look at the cash value, that's what shows up. So that is based on a non-guaranteed dividend as well. This column right here, I'll circle this in black, basic policy cash value end year represents what the cash value buildup is based on 1, the base premium only, and 2, the guaranteed rate. So anytime you see this column, basic cash value or basic policy cash value, that represents the cash value buildup based on the base premium only. No additional PUAs, nothing like that. Base premium only. And then if the guaranteed rate only is applied to the base premium. And I mention that because what do you see here? 0 in the first and second year. Okay, so as we look at this, we continue to make our payments each year, $10,000 per year, easy to track. How much have you paid in here? Year 15. Year 15, you've paid in 150 grand. There's your cash value, 155 and change. The year prior, you've paid in a total of $140,000, 10K per year for 14 years. You've got 138. So that's 15 years just to get your money back. Sound like a good deal? Not at all. This is often where we hear whole life insurance stinks. I want nothing to do with it. There's no way I'm paying money into one of these policies. So how do you make it better? How do you make it very attractive and copy what people have done successfully with whole life, especially corporations and such? So what we're going to do is look at the same policy now, but blended for maximum cash value. So we've got a little bit more going on here, but that's okay. I'm going to walk through it. So you'll see the allocation in this example, or before I say allocation, your total out of pocket, 100K per year. Same product, Whole Life 100, with LISR, that stands for Life Insurance Supplement Rider. We added term insurance to the policy. The purpose for the term rider, and we didn't touch on this, we have it in earlier videos, but a term rider is a very cost-effective strategy to raise the MEC limit. So one thing we have is the insurance company's limits. This example we're looking at here is Mass Mutual. Wherever we set our base premium, they will allow a policyholder to make a total payment of 10 times that per year. So if this is you, you're saying, okay, I've got 100 grand going in, and this could be $1 million, this could be 10,000, the ratios are all the same. Of this 100K, how do I know that this guy, Steve, is really showing me options that are in my best interest, what he would do? How do I know there's no kind of games going on with the illustrations? Because this stuff happens so much in the industry. And the answer is this. Where's your money going? Here's your premium piece, $10,000. That's your underlying base premium. Mass Mutual as a company will allow one to 10x your base premium with respect to the total annual payment, 100K. So what we did here is based on the client's ability or desired payment of 100K per year, we set the underlying premium at $10,000, and we can 10x that. We have different riders, LISR, AILR. AILR is a pure PUA rider, but here's what I want to touch on. Going back to that whiteboard demonstration, what happens with the base premium in the first and second year? Base premium's what? 10K. What happens with it? Does not show up in cash value in the first and second year. So what you'll find actually, to be very, very consistent, look at this column. Basic policy, cash value, and year. Remember what this means? This is based again on the base premium only. If you were to only pay that, and only the guaranteed rate is credited to it. So Mass Mutual's Whole Life 100, their guaranteed rate is 3.75%. It's the minimum floor with this product. So you've got a total of 100 going in, but look at this, 0 years 1 and 2, 19,610 in year 5, 60,620 in year 10. Keep those numbers in mind. Just for one number, 60,620. I'm going to go back to the other example with the pure base premium. Look at this. If we look at that same column, basic policy, cash value, year end, year 10, it's identical. And again, that's because this column only represents the underlying base premium and the cash value buildup based on the guarantees. Personally, when you customize a policy, I think it's somewhat useless. So here's going back to the custom policy. So what do we got here? 100K per year going in. There we go. Cash value right off the bat. This column, total cash value and year. Just about 84%. I paid in 10. I've got 83,834. What is not showing up in cash value here? A couple things. Base premium, that does not show up in cash value. Of this guy, I've got term insurance here. There is right around, or to estimate, $1,200 that goes toward the term insurance cost. Actually be a little bit less than that, but there's a term expense. Remember the purpose of that term rider? Cost-effective way to raise the death benefit. If you said, I don't care about the death benefit, that's what the death benefit has a direct relationship to. An individual's age and total death benefit on a life insurance policy, or I should say the MEC limit, that has a relationship too. So, going back to this, okay. Premium, PUA rider, term cost, and then the PUA rider fee does not show up in cash value either. That's why I've got about 84%. As I look at this guy, what do I notice here? Continue to make payments. Year 1, you pay in $100,000. You've got, call it $84,000. No matter how you slice that, that is a negative 16% hit. It's actually a little bit more than that. Not that attractive. Year 2, you pay in $100,000. Your cash value grows from, call it 84 to 172.5. Did I get the full 100 back? If you did, it would grow from 84 to 184. So I did not get the full amount back. Again, what did not show up in cash value is primarily that base premium. That's taking the biggest bite out of your cash value. However, year 3, look at this. You make the same 100K payment in this example. What happens? You get just about all of it back. Next year, paying 100K grows from 270 to 374. You get the 100K back and a little bit more on top of it. The policy's compounding each year. Let's go back to the all base premium example again. You'll see a similar pattern here. Year 1, this is just the basic premium example, nothing in cash value. Year 2, a little bit in cash value. Year 3, I start to get more and more back. Since it's all going toward premium, it does take longer to build up. We don't really sell this at all because no one ever wants it, at least those who we work with. So back to the better example. What do we notice? Breaking even just about year 6, where I've paid in 600, I've got about 597, and I am positive year 7. Okay. And then in this example, we keep on pumping money into it. So we've got a minimal premium, maximum PUA allocation, and things look good. So we're going to look at the guaranteed values of this as well and compare them side by side with the current dividend values, because I like to show that from a transparency standpoint. Before we do that, let's look at the L99 example so you can see it with a different company real quick. So whole life 100. Now we're going to look at the life paid up at 99, which is a similar product with a different life insurance company. We like to look at different options here. So here we go. Whole life 99. Very comparable when we look at the two. All base premium. Base policy premium, 10,000. Look at this. There's that column, base guaranteed cash value. What's so consistent about this? Years 1 and 2, nothing shows up in cash value. Look at year 3, 5602. Is that similar to what the Mass Mutual example was? It is. Remember what the Mass Mutual example was in year 10? It was $60,000 and change. Look at that. So again, I'm not a fan of this column because it represents the guaranteed cash value buildup based on the base premium only. The instant you start getting fancy with the policy, which we always want to do to juice the cash value, that's where this column, I don't like it from a guaranteed standpoint. But this is their L99 policy, years 1 and 2. Nothing shows up in cash value. Next to nothing. You do have $560 in year 2. Year 3, you pay in 10K, got close to about 6,500 of it back, and then more and more each year. The Mass example took about 15 years to break even. Here, takes about 15 years to break even. That's a long time. Shall we juice the policy? I think we should. So, identical design to the Mass Mutual option. 10K base premium, 90,000 PUA. Here's your term rider. There's your term rider cost, about $500 initially. But as we look at this guy, designed it a bit differently, well, funded it a bit differently, I should say, where we've got the 100K per year going in for 5 years. Year 1, 82,000 and change in cash value, meaning you paid in 100. What did not show up in cash value was, again, the base premium, the $500 that went toward the term cost, and then also the PUA rider charge. Year 2, you pay in 100 grand. It grows from 82 to just about 172. So you don't get your full 100K payment back. You have a loss there. Next year, you pay in 100K, grows from 171 to 270, just about all of it back. And then each year thereafter, you're getting more and more back, breaking even between years 5 and 6. And this is a traditional Guardian policy. And then we continue to pay in 10K. Could pay more in than that if we wanted to. But Guardian, with their product features, where they work really, really nicely is if you wanted to really stuff a policy initially and then cool off or stop funding altogether. We'll hit on that more during our hybrid video, hybrid whole life product. So let's go back to the whole life 100 product. And this was $100,000 per year going in up until the age of 65, 25 years. So what I like to look at here is what the policy looks like, not just based on the present dividend rate, but what does the worst case scenario look like? Because again, the benefit to a traditional whole life insurance policy is what? If I want to keep on making payments for a long period of time, whether I want to do that and I'm very certain, or if I want that option open. Because remember, you can always front load a policy, stop paying, and then open up another one after the fact. But what's the worst part about a policy? First and second year, especially with a traditional policy. What's the best part about a policy? Every year after that, where if I have the ability to keep pumping money into it, that can definitely work in my favor. So I like to see those options up front and the pros and cons. But with that said, me personally, I like to see the worst case scenario. I've never seen any of the major mutuals deliver just the guaranteed cash values to policyholders. When they're designed poorly, when they've been designed poorly, I've seen them deliver close, but I've always seen them do better and that's one of the big reasons I like them. But at the same time, it's good to see it. I am a huge advocate of showing not just what looks the best, but what looks the worst. Because if you're someone who looks at a policy or any type of product and says, I got to see the worst case scenario, and if I'm just not comfortable with it, well, how I view that being on the other side is, boy, am I glad we looked at that and you decided that after the fact, as opposed to, or I'm sorry, before the fact, meaning you didn't move forward because you saw that and you're just not comfortable with it, as opposed to trying to hide it and then eventually you find out about it. That happens way too much in the industry and has caused so much grief and really given the industry a bad name, in my opinion. So there's the guaranteed values. Here we go. Pumping money in, 100K per year, breaking even really at year 11. At that point in time, 100,000 has gone in for 11 years, 1.1 million, you have 1.1 million. The annual IRR represents the net growth rate that you experience in the policy each year. So I'm isolating, hey, what did I earn in the first year? Paid in 100 grand, got 82 and change, it's a negative 17% internal rate of return. Ouch! Year 2, I pay in 100 grand, it grew by not $100,000, I've got a negative 8% internal rate of return. Guarantees aren't that attractive. Here's the annualized IRR. Average IRR over 10 years, what do I have? Still in the red. As time passes, it does get better. Now again, this product has always done better. This company has done way better than the guarantees, but still, it's good to see it. Don't try and hide it. Whole life 100 based on the dividends. This will match the illustration, as we always pull numbers from illustrations and export them onto Excel. Been doing that since day one. Annual IRR, average IRR, same thing. Here's one thing I'll add as well, which is important depending on what your goals are, because I know this has been a lengthy video with a lot of numbers and I love going through this stuff, is depending on what your goals are. If you are looking for maximum internal rate of return on cash value, which a lot of people we work with, a lot of analysts, CFOs, data scientists, engineers that we work with, want that IRR maximized. Traditional whole life insurance policies typically do not accomplish that. The advantage is you can keep pumping money in, but, and we'll touch on this during our limited pay and hybrid product series, is if I take a policy and I max fund it for 5 years, 7 years, can even go 10 years and then stop, you'll see typically the strongest internal rate of return on a product. Typically, depends on the company and how they credit dividends to their limited pay products and different options. But a traditional policy typically will offer closer to the weakest internal rate of return, but the advantage is I can keep on feeding it. So a question I like to ask myself in these cases is, do I like a policy where I want maximum internal rate of return and what's the most money I can get into it over 10 years? Say it's a 5% IRR. Or do I want a policy that might only pay me a 4 to 4.25% IRR, but man, I can keep on feeding it as long as I'd like. I can get a larger amount of money in, but then I've got a lesser return, internal rate of return that is. Hope that made sense. So to sum this bad boy up, when we look at traditional whole life insurance products, fantastic options, very popular in the industry. Most consumers, if you own a whole life insurance policy, if you've ever been presented it before, it was probably this. Good option if you want the ability to keep on pumping money into it for a long period of time. If you're uncertain on how long you'd like to pay into it, this is a good option. Uncertain and you think you might want to keep on going for a long time. If you said, hey, I'm going to be done at a certain age, 10 years or less, 20 years or less, 20 years max, I might want to go for 5 years. There's better options than this in most cases. But to get back on track, if I want the ability to fund for a long period of time, I want a low premium. This is typically the easiest option to achieve a true 1090 split with, or as low as I can drive that premium with a particular insurance company. So I hope you enjoyed this one. I did. If you did, please hit the like button, subscribe for more, and as always, I hope this helps. Thanks so much. Hey guys, Steve Parisi here. If you enjoyed the content you just saw, please subscribe, like, and hit the notification bell for future videos. If you'd like more information or to see some custom policies for yourself, feel free to call or email our offices at the contact information below.